CMQ investors, welcome to the show. This is Chris Franco, and I need to talk to you about this dilemma that I'm going through with Alibaba. If you watch the video about my portfolio allocation, then you know Alibaba, I believe it's 12% of my portfolio right now. Now, I try not to go beyond the 10% point for any individual stock, and that video explains all the details. But I'm having a dilemma because in my gut, I say, oh, I shouldn't buy anymore, right? Like just, you bought plenty, just wait it out. It's a long-term investment. But when I look at what I've learned over the years from the best investors ever, and again, I'm such a nerd about this stuff. I've studied, the wisdom of whether it's Charlie Munger, Warren Buffett, you name it. The most rational thing for me to do if I really believe that Alibaba has good long-term prospects would be to buy more. And I'll tell you why. My cost basis for Alibaba, wait for it, drum roll, 128. And right now, shares of Alibaba, I believe they went down today, which, it's going to be volatile. But I believe they're at like 111. That was the last time I looked. Which was, like the last time I looked, it was like, meanwhile, 3 seconds ago. So it's 110 today. So if I believe in the long-term prospects of Alibaba, it would be rational for me to buy more, despite the fact that I don't really want to go past 10% for any one position. Now, here's why I think it's rational, and I'm saying it's rational, but I'm acting potentially irrationally. I just want to think this out with you. Right now, if I look back at a couple things, I'll start with a Warren Buffett quote, and I posted this on Twitter. Let me make sure I have the exact quote. To paraphrase it, though, it's basically like occasionally stocks are trading at very silly prices, and that's how Charlie and I have gotten very rich, something along those lines. The second piece here comes from a book that I recommend all the time, which is the Warren Buffett Portfolio by Robert Hagstrom. That when you have a stock that you own that's trading for a price below the price you paid, that's actually a welcomed opportunity because you can buy more of something that you already think has good long-term prospects and ideally something that you already bought with a margin of safety. If my average cost paid, or rather my cost basis, my average price paid for Alibaba is 128 and it's currently at 110, well, the rational thing to do would be to buy more. But there's that fear factor of, well, I could be wrong, and then I'm going to, take a bath, or more of a bath than I'd prefer to take. I never put myself in a position where one investment can kill me. That's just something I instinctively know not to do. And I'm always mindful of the fact that overconfidence is a killer for us as investors. That's proven. I mean, you don't need to read all the studies that I've read on it, but all the studies show that. So anyway, that's just what I'm thinking through right now. And I wonder, the rational decision would be to buy more, but that irrationality creeps in and I play it safe. But to go back to now something Charlie Munger has said, the opportunities in life are rare, the really big opportunities. And I'm paraphrasing again, but when you find something, when there's that occasional mispriced opportunity, you don't want to look back and say, oh, I was timid. At the same time, you don't want to look back and say, well, I was overconfident. So I think the thing I'm kind of thinking out my answer here. I think what I need to do is tell myself where potentially like I've gone too far in terms of the percentage of my portfolio, but also realize that, this is something I have done. I really do know my stuff. I don't buy individual names without doing thorough research. Now, I wasn't always like that as an investor, but that's been something that I know, that works, right? You can be wrong. But the last thing I want to say, and this goes back to an analogy that both Charlie and Warren have done or said about the stock market being like the parimutuel system, which is like the horse track or the horse betting. I didn't grow up in the 1930s and 40s, so I didn't go to the track. But something to think about there is, you want to find something that your odds are 1 and 2, but it's paying 3 to 1. And I think Alibaba is a prime example of that. Like, there's no guarantee that it works, but it's a mispriced gamble right now. Like, that's kind of where I see it. So just some thoughts there. But I think with Alibaba right now, my thesis is still intact. Alibaba it's the dominant player in e-commerce in China. There's big upside, in my opinion, on the cloud computing business. It's a company that, yes, there is some short-term global macro headwinds, but while there could be more of that, I have to remember that I'm a long-term shareholder. So I can't base my investment choices based on what I think may happen in the next month, year, 2 years, 3 years. That's just not the way I can invest. There's no advantage of investing like that for me. There's none. I have to keep that in mind when I'm thinking about what are the long-term prospects. I can't worry about the macro stuff. Now, with that said, thank you for watching this video. I hope you'll leave a comment below with your thoughts. I always love to hear from you. If you haven't already, please subscribe to the channel. Make sure you hit the bell. I have a lot of new content that I'm putting out every single week, and I want to make sure that you know about it and you're able to use it before everyone else. For CMQ Investing, this is Chris Franco. Thanks again for watching. We'll talk soon.